Real estate principles. Unit 9, Government and other financing. Learning objectives. When you have completed this unit, you will be able to accomplish the following. State the eligibility requirements for an FHA insured VA guaranteed and Calvert home loan. List the loan fees involved with the FHA insured, VA guaranteed, and Calvert home loan. Describe the forms of creative financing. Explain how the secondary mortgage market aids home buyers. Describe several ways in which the Economic Stimulus Act of 2008 helped home buyers. Key terms. Government-sponsored financing. Loans that do not involve government cooperation are called conventional loans. Loans that are created or financed with the help of a government source are non-conventional loans, and they are the focus of this unit. Both federal and state programs are discussed. Federal Housing Administration. The National Housing Act was passed in 1934 in response to the numerous foreclosures brought about by the Depression and has been amended many times since. One of the agencies created by the National Housing Act was the Federal Housing Administration, FHA, a division of the Department of Housing and Urban Development, HUD. FHA does not make loans, but it insures loans made by lending institutions such as thrifts, banks, life insurance companies, mortgage companies, and others. FHA has been a major force in determining how lending practices are carried out. Information about HUD and FHA programs can be found at hud.gov, fha.com, or by calling 1-800-CALL-FHA. The HOPE hotline, 1-888-995-HOPE or 995hope.org, provides free mortgage counseling in English and other languages 24 hours a day, 7 days a week. Section 203. Section 203 of Title II of the National Housing Act specifies eligibility requirements for federal mortgage insurance for housing construction and finance. Section 203B covers mortgages on 1 to 4 family homes. Section 203K covers loans for property renovation. FHA insures approximately 7 million loans valued at almost $400 billion through this and its other programs. FHA insured loan limits. Insured loan amounts are adjusted annually to reflect changes to the maximum amount allowed for loans that are held or backed by the organizations such as Fannie Mae and Freddie Mac, which comprise the secondary mortgage market, discussed later in this unit. FHA insured loan limits are set at 65% to 150% of the limit for loans purchased on the secondary market, with the higher loan limits available for higher cost areas. For current FHA loan limits in your county, check the following website, entp.hud.gov. Condominium loan limits are approximately the same as those for single-family residences in the same county. Legislation raising FHA loan limits created the FHA Forward program. FHA also has the Home Equity Conversion Mortgage, HECM, a reverse mortgage program for homeowners age 62 or older, and loans available through the Hope for Homeowners program. A refinancing plan for homeowners having difficulty making mortgage payments but who can afford a new FHA insured loan. Total cash investment. The minimum cash investment made by a borrower on an FHA insured loan must be at least 3.5% of the sales price, provided the borrower has a credit score of at least 580. If the borrower has a credit score of 500 to 579, the required down payment is 10%, although other factors such as late payments on existing debts may result in denial of the loan application by FHA. A borrower with a credit score of less than 500 is ineligible for FHA insured financing. Mortgage insurance premium and monthly fee. FHA insured loans have both an upfront mortgage insurance premium, MIP, that is paid to FHA at closing, as well as an annual renewal fee, which is paid on a monthly basis. The upfront MIP is not considered an acquisition cost of the loan in computing down payment. The premium may be paid by the borrower or someone else, or it may be included in the loan amount. Presently, the FHA MIP is 1.75% of the loan amount for all purchase loans and 2% for home equity loans. The MIP is refunded if a loan is prepaid, paid in full before the end of the loan term. The annual insurance charge, which is paid in monthly increments, depends on the loan amount, loan term, and the loan-to-value, LTV ratio. FHA insurance may be canceled for loans originated after January 1st, 2001, For loans that originated before June 3rd, 2013, the FHA monthly mortgage insurance payments automatically terminate when one of these conditions is met. If the mortgage term is 15 years or less and the loan-to-value ratio was 90% at the time of origination, the annual premium will be canceled when the loan-to-value ratio reaches 78%, regardless of the amount of time the borrower has paid the premiums. If the mortgage term is more than 15 years, the annual premium will be canceled when the loan-to-value ratio reaches 78%, provided the borrower has paid the annual premium for at least 5 years. For loans that originated on June 3rd, 2013 or later, the following apply. If the original mortgage term was 15 years or less and the original LTV was 78% or less, the mortgage insurance premium will be terminated after 11 years. If the original LTV was greater than 90%, the mortgage insurance premium will continue for the loan term. If the original loan term was greater than 15 years and the original LTV was not greater than 90%, the mortgage insurance premium will be terminated after 11 years. If the original LTV was greater than 90%, the mortgage insurance premium will continue for the loan term. Interest rate and loan term. The interest rate may rise or fall with prevailing market rates. The loan term may not be longer than 35 years if the loan is approved before construction, or 30 years otherwise. The 30-year term has been the most popular with lenders and borrowers, but shorter-term loans are beginning to gain favor. Generally, loans must be fully amortized in equal monthly payments that include both principal and interest. Monthly payments also include impounds for taxes, special assessments, and fire or other hazard insurance. Prepayment penalty. FHA insured loans have no prepayment penalties. Points. 1 discount point is 1% of the loan amount paid up front. A lender can charge discount points, prepaid interest, to the borrower in addition to the 1% loan fee. Discount points are the lender's way of increasing loan income while keeping the interest rate at a competitive level. 1 discount point equals 1 percentage point of the loan amount. Discount points are paid at closing by the borrower or someone else. Usually the seller pays discount points to increase the lender's effective yield, even though the borrower may be offered a lower than market interest rate. On loans of the same amount and term, 1 discount point increases the overall yield on a loan by approximately 1/8%. Thus, a loan at 4% and 3 discount points effectively earns 4 3/8% for the lender. For example, J is selling a single-family residence in Solano County. M has offered $459,000 contingent on securing financing. J accepts the offer. A lender approached by M is willing to make a loan of $367,200 to carry an interest rate of 5.5%, with 2 discount points to be paid at closing when the loan is funded. What is the amount of the discount points and who will pay them? The discount points are valued at $7,344, $367,200 times 2%, and are payable as stipulated in the agreement between the buyer and seller. Discount points are a matter for negotiation between buyer and seller. Regardless of who pays, the contract of sale should stipulate who will pay and set a limit on the number of discount points that will be paid. Seller-funded down payment assistance programs. As of October 1st, 2008, FHA prohibits the use of down payment assistance programs funded by those who have a financial interest in the sale, such as the property seller. Programs provided by nonprofits or funded by other sources, such as churches, employers, or family members, are still allowed. Allowable seller concessions, such as payment of discount points, cannot exceed 6% of the home purchase price. Types of loans available. In addition to the traditional fixed-rate amortized loan, FHA allows use of a graduated payment mortgage GPM. The GPM is available for families who expect income to increase over the loan term and who otherwise would not qualify for a mortgage loan. Only single-family residences are eligible. With a GPM, monthly payments do not cover all of the interest due. The unpaid interest is added to the remaining balance of principal owed. This negative amortization process continues for 5 to 10 years, depending on which of 5 different GPM plans is used. At that point, monthly payments stay the same to the end of the loan term and are fully amortized. Because interest is paid on interest, the statute specifically preempts any state usury laws that might be violated. FHA allows an adjustable rate mortgage. ARM for owner-occupied residences of no more than 4 units. The rate of interest charged is adjusted by increases in monthly payment, outstanding principal balance, loan term, or a combination of the three. Maximum loan term is 40 years. Adjustment of the interest rate must correspond to a specified national interest rate index. Adjustments of no more than 1% of the outstanding loan balance may be made annually, with an increase of no more than 5% over the initial contract interest rate over the life of the loan. At the time of application, the borrower must be given a written explanation of the loan features and possible rate and payment increases over the loan term. FHA also allows a shared appreciation mortgage, SAM, for a dwelling of 1 to 4 units. Buyer qualification for an FHA loan. The following rules are aimed at reducing the number of defaults on FHA insured loans, in addition to preventing defaulting borrowers from acquiring more credit. Total seller contributions, including discounts, buy-down costs, and closing costs, cannot exceed 6% of acquisition cost. The borrower must be qualified at the full note rate rather than the buy-down rate. The borrower's Social Security number must be supplied on the loan application to assist in reporting of delinquent and foreclosed loans to other federal agencies and to credit bureaus. HUD Direct Endorsement Plan. Under HUD's Direct Endorsement Plan, qualified lenders may process a loan without prior HUD review, except for construction projects. This program thus eliminates the lengthy processing time that is one of the major drawbacks of the federally insured loan. National Housing Trust Fund. The Housing and Economic Recovery Act of 2008, HERA, created the National Housing Trust Fund, NHTF, to be funded by a percentage of profits from the government-sponsored enterprises mentioned later in this unit. The NHTF is intended to provide revenue to communities to build, preserve, and rehabilitate affordable rental homes for extremely and very low-income households. Total funding for 2020 was $322.6 million, with California receiving almost $51 million of that amount. The program is administered in California by the California Department of Housing and Community Development. More information on NHTF is at nlihc.org/issues/NHTF. Department of Veterans Affairs. The Service Members Readjustment Act of 1944, the GI Bill of Rights, helped ease the transition into civilian life of World War II veterans. The programs later were expanded to include veterans of subsequent conflicts. The GI Bill also covers the surviving spouse of an eligible person who died as the result of a service-connected injury, and the surviving spouse of a person missing in action or listed as a prisoner of war for more than 90 days. Benefits are available as long as the surviving spouse remains unmarried. Information on the GI Bill is at gibill.va.gov. The Department of Veterans Affairs, VA, presently authorizes first mortgage loans as well as second mortgage loans of less than 40% of property value. The VA guarantees payment of the remaining mortgage indebtedness up to a maximum amount. If the borrower defaults, the VA will pay the lender's net loss up to the amount of the guarantee, which is decreased proportionately as the loan amount is repaid. There is no cost to the borrower for the VA guarantee. The certificate of eligibility shows the veteran's entitlement. The VA also makes loans to veterans directly in areas where there are few mortgage lenders. Because of the abundance of financing sources in this state, there are no direct VA loans to veterans in California. Borrower qualifications. VA guaranteed loans are available to those men and women who served in the U.S. Armed Forces and were other than dishonorably discharged, and to their spouses, as mentioned above. The period of active duty required varies depending on the date of service. Current service eligibility requirements can be found at the VA website. Lending institutions are able to screen VA loan applicants for eligibility as part of the loan qualification process. Supervised lenders verify the veteran's entitlement, then process the loan as usual. There is no need for VA review and approval. An interested veteran should request a certificate of eligibility from the nearest VA regional office in advance of loan application. The certificate will indicate the amount of loan guarantee, called the veteran's entitlement, available to the veteran. If VA records indicate sufficient data on the veteran, an automated certificate of eligibility, ACE, can be obtained by a lender using the internet, and the certificate will be issued online within a few seconds. The Native American Direct Loan (NADL) program helps Native American veterans purchase, construct, improve, or refinance a home on Native American trust lands. the veteran's tribal organization must participate in the VA Direct Loan Program, and the veteran must have a valid certificate of eligibility. Loan guarantee amount. VA guaranteed loans can be made for purchase, construction, repair, or improvement of a veteran's dwelling, which can be a building of 1 to 4 units or a condominium. The basic veteran's entitlement is $36,000 for a loan of up to $144,000, but there is no loan ceiling. For a loan greater than $144,000, the VA will pay up to 25% of the loan amount if the veteran defaults. The VA makes a specially adapted housing SAH or Special Housing Adaptation SHA grant available to service people and veterans with certain total and permanent disabilities related to their military service. The maximum amount allowable for an SAH grant in 2022 is $101,754. The maximum amount allowable for an SHA grant in 2022 is $20,387. The maximum is subject to adjustment upward annually based on a cost of construction index. No individual may use the grant benefit more than 3 times up to the maximum amount. The VA also makes grants for service people and veterans temporarily residing in homes of family members, Temporary Residence Adaptation TRA. The maximum amount of a 2022 TRA grant for SHA is $7,318, and the maximum amount of a 2022 TRA grant for SAH is $40,983. Restoration of entitlement. The amount of a veteran's entitlement can be restored once if the veteran refinances a VA loan with a conventional loan. The veteran's entitlement is increased to the full amount if the property is disposed of and VA guaranteed loan is paid in full. The VA is released from liability on the original loan. Any loss suffered by the VA has been repaid in full, or the property is transferred to another veteran who is entitled to VA home loan guarantee benefits. There must be a release from personal liability to the government on a VA loan before an assumption of the loan by a purchaser of the property. Otherwise, the veteran remains liable under the original terms of the guarantee. Such a release should be a condition of the sale specified in the contract. If the property is foreclosed and there has been no act of fraud, misrepresentation, or bad faith by the veteran, the VA can release the veteran from further liability. Notice of value. The lender will request a determination of reasonable value from one of a panel of VA recommended appraisers who will provide a notice of value NOV, formerly called a certificate of reasonable value, for the subject property. The veteran must be given a copy of the NOV before signing a contract of sale, or the contract should include a contingency that the veteran be able to either affirm or withdraw from the transaction without penalty if the NOV value is less than the purchase price. Types of loans available. Veterans have had a choice of 4 payment plans. Fixed term is a fully amortized mortgage for up to 30 years and 32 days. Adjustable rate mortgage ARM is similar to the FHA program but based on the Treasury Securities Index on loans initiated before October 1st, 1995. These loans are no longer available. Growing equity mortgage GEM is tied to an index and results in increases in payments with the increases applied to the principal balance. The GEM is a formalized way of making additional principal payments which increases the accumulation of equity and shortens the overall loan term. Graduated Payment Mortgage GPM provides for lower initial monthly payments, increasing at a rate of 7% annually for the first 5 years. From the 6th year to the end of the loan term, the payments remain the same. Unlike FHA, which allows 4 other variations of the GPM, the VA allows only this one form of graduated payment. Some restrictions apply on manufactured home loans. The manufactured home must be at least 40 feet long and 10 feet wide, with a minimum of 400 square feet and installed on a permanent foundation. The maximum loan term for the purchase of a single wide manufactured home, with or without a lot, is 15 years and 32 days. The maximum loan term for the purchase of a double-wide manufactured home, with or without a lot, is 20 years and 32 days. Interest rate. The VA now allows borrowers to negotiate the interest rate on a VA guaranteed loan with the lender. Down payment and closing costs. As long as the estimate of reasonable value does not exceed the amount of the VA loan guarantee, the VA does not require a down payment, although the lender may. The loan guarantee can never be more than the estimate of reasonable value, but a higher purchase price may be negotiated if the veteran pays the difference between the reasonable value and the purchase price in cash at the closing. The cash must come from the personal resources of the veteran and not from secondary financing. The NOV sets the maximum loan amount the VA will guarantee. On the first use of a VA guaranteed loan with a down payment of less than 5%, a funding fee of 2.15% of the loan amount is charged, 2.4% for veterans of the reserves or National Guard on loans closed on or after November 22, 2011, through September 29, 2024. With a down payment of at least 5% but less than 10%, the fee is 1.5% or 1.75%. With a down payment of 10% or more, the fee is reduced to 1.25% or 1.5%. Subsequent use of a VA guaranteed loan carries a higher funding fee, presently 3.3% for all veterans making a down payment of less than 5%, 1.5%, or 1.75%. With a down payment of at least 5% but less than 10%, and 1.25% or 1.5% with a down payment of 10% or more. There is a funding fee of 1% for all manufactured home loans. The veteran can pay discount points, which are subject to negotiation with the lender. Veterans are permitted to finance discount points. Refinancing. An existing VA loan can be refinanced with a VA Guaranteed Interest Rate Reduction Refinance Loan, IRRRL. The reasons for the refinancing, which must be acceptable to the lender, can include repairs or improvements to the property or providing the veteran with funds for educational purposes. A veteran can refinance an existing VA loan if the new loan will carry a lower interest rate. The amount refinanced cannot exceed the remaining balance of the existing loan plus allowable closing costs, which may include discount points. The amount financed cannot be greater than the original amount guaranteed, and the overall loan term must remain the same. No additional amount will be charged against the veteran's entitlement. On a refinancing loan, the funding fee is 5% in all cases. Loan servicing. The VA is available to help a veteran even after a loan is secured if the veteran is having a problem making loan payments. If a loan is delinquent 3 months, a notice of default alerts the VA to the situation. Financial counseling is provided to help the veteran pay arrearages and avoid future missed payments. FHA versus VA loans. At present, there are fewer distinctions between FHA insured and VA guaranteed loans than there have been in the past. The differences that still exist involve the following factors. Loan purpose. Both FHA insured and VA guaranteed loans are available for first mortgages of owner-occupied property. VA loans also include junior liens for repairs or improvements. Although FHA technically allows some types of secondary financing, for all practical purposes the FHA market is first mortgages only. Loan amount. VA guarantee limits do not set the upper limit of the loan amount. FHA loan maximums are exactly that. Interest rate. Both VA and FHA allow lenders and borrowers to negotiate the interest rate offered, which can vary from lender to lender. Both FHA and VA allow a variety of loan types. Down payment and closing costs usually are lower on a VA guaranteed loan than on an FHA insured loan. VA allows lenders to charge reasonable costs, including credit report, survey, title evidence, and recording fees. The VA does not have a charge for mortgage insurance, but loan origination costs can be included in a flat charge that cannot exceed 1% of the loan amount for most properties. In certain cases, the veteran may be charged discount points. The VA funding fee depends on the down payment and origination date. Loan prepayment. Both agencies allow full or partial prepayment of principal at any time. The VA does require that any prepayment be at least $100 or the amount of one installment. Refinancing to avoid default. Both FHA and VA loans can be refinanced to avoid imminent default, so that payments may be extended beyond the initial loan term. VA loans can be refinanced only if 80% or more of the new loan will be paid within the original loan term limit. The FHA loan term on refinancing can be no more than 3/4 of the remaining economic life of the building. HERA has provided a refinancing program for homebuyers with problematic subprime loans, allowing lenders to write down qualified mortgages to 90% of current appraised value and providing qualified borrowers a new FHA 30-year fixed-rate mortgage at 90% of appraised value, up to a maximum loan amount of $550,440. Borrowers share 50% of all future appreciation with FHA. The Helping Families Save Their Homes Act, which was signed into law by President Obama on May 20th, 2009, gives FHA more enforcement capabilities against lenders who use false or misleading marketing tactics. RESPA. Note one final similarity between FPIA insured and VA guaranteed loans. Because both are federally related, both fell within the requirements of the Real Estate Settlement Procedures Act RESPA. Down payment. VA generally does not require a down payment, although the lender may. FHA requires a down payment of at least 3.5% of the sales price or appraised value, whichever is less, service charges. FPIA allows a service charge of 1% on loans involving existing buildings and 2% on loans for buildings to be constructed. Buyers can be charged discount points, which are a subject for buyer-seller negotiation. Seller contributions cannot be more than 6% of acquisition cost as of March 2012. The buyer also can be charged an FHA application fee and fees for credit report, appraisal, and other closing costs. California Veterans Farm and Home Purchase Program. The California Veterans Farm and Home Purchase Program, CalVet, was created in 1921 to assist California veterans in acquiring home or farm property. The program is included in Division 4, Unit 6 of the Military and Veterans Code, CalVet Loans. CalVet loans are administered by the California Department of Veterans Affairs, CDVA. CDVA buys the selected property from the seller and resells the property to the veteran on a land contract explained later in this unit. CDVA holds title until the veteran has repaid the amount owed, although the veteran has the right to possession of the property as his personal residence. CalVet loans can be used to purchase an existing home, finance a lot purchase and new construction, rehabilitate a home purchased as is, and make home improvements. All properties purchased with a CalVet contract, except for mobile homes and condominiums, are covered under the Fire and Hazard Insurance Program. In addition, a master disaster indemnity policy provides insurance coverage for losses due to flood and earthquake. The maximum CalVet loan amount varies by county and is 125% of the maximum Fannie Mae loan limit, 150% for farm loans. A home improvement loan can be made for up to $150,000. Eligibility requirements. CalVet loans are available to most veterans planning to buy a home in California. Prior or current California residency is no longer a requirement. CalVet loans are available to any veteran who served a minimum of 90 days on active duty, not including active duty for training purposes only, or was discharged due to a service-connected disability, or is eligible to receive a U.S. Campaign or Expeditionary Medal, or was called to active duty from the Reserves or National Guard due to a presidential executive order. CalVet loans are available to currently active duty personnel. The applicant or a member of the applicant's immediate family must occupy the home within 60 days of close of escrow and continue to occupy the home until the loan is paid in full. A current member of the Reserves or California National Guard who has served a minimum of 1 year of a 6-year obligation is also eligible, provided the applicant is a first-time homebuyer or purchases a property located in a targeted area. In some instances, unremarried spouses of veterans are also eligible. If funds are in short supply, which is not usually the case, preference will be given to wounded or disabled veterans, then former prisoners of war and unremarried spouses of those missing in action or prisoners of war. Then Vietnam-era veterans and Native American veterans applying for loans on reservation or trust land, then all other eligible veterans. Loan qualifying. Loan application must be made before purchase. The veteran must meet ordinary standards of creditworthiness, interest rate, and loan term. Interest rates offered on CalVet loans are updated annually based on rates paid on the bonds that fund the program. The loan term is either 20 or 30 years. Prepayment of principal can be made at any time, which can shorten the loan term. CDVA offers 4 funding interest rate programs. A veteran's eligibility for each program may vary based on income or purchase price limits, prior home ownership, and wartime service. The rates posted for these programs in 2022 range from 2.73%, 3.124% APR for a 20-year term to 3.125%, 3.394% APR for a 30-year term. A rate of 5.99%, 6.294% APR is available for eligible veterans who do not qualify for a lower rate. The interest rate on a loan on a mobile home in a park is 1 percentage point higher than that. The APR is based on a $200,000 sales price, 10% down payment, financing the VA funding fee under the CalVet VA loan program, and a 1-year premium for disaster insurance. Prepayment. CalVet loans may be prepaid at any time without penalty. Change of residence. A veteran can obtain a new CalVet loan as long as the first loan is paid in full or awarded in a divorce to a non-veteran spouse. As with all government loan programs, CalVet loan requirements are subject to change at any time. Anyone interested in such a loan should contact the closest office of the California Department of Veterans Affairs via the website or telephone. Mortgage assistance. The California Military Families Financial Relief Act allows for the deferral of mortgage payments secured by the principal residence of a member of the Reserves or National Guard who is called to active duty. The loan does not have to be a CalVet loan. California Housing Finance Agency. The California Housing Finance Agency, CalHFA, was chartered in 1975 as a self-supported affordable housing bank to make low-interest loans funded by the sale of tax-exempt bonds. CalHFA bonds are repaid by mortgage loan revenue. The CalHFA Conventional Loan Program offers a fully amortized 30-year fixed-rate first mortgage loan. As an added benefit, the CalHFA loan can be combined with either the My Home Assistance Program, My Home, or the Extra Credit Teacher Program, ECTP. Information on current CalHFA borrower requirements and loan programs can be found at calhfa.ca.gov. Creative financing. When interest rates are high, there is an oversupply of properties for sale or rising prices make housing less affordable. Sellers frequently help to finance property purchases. Seller financing and other techniques can bring down the effective interest rate paid by buyers and make property purchases more attractive. Some of those creative financing techniques are discussed next. Purchase money trust deeds and mortgages. The purchase money trust deed or purchase money mortgage can refer to any loan used to finance the purchase of real estate, but also refers to the security interest given by buyer to seller at the time of purchase to secure all or part of the purchase price. The purchase money thus may come from either a third party, such as an institutional lender, or in the form of credit from the seller. Typically, the seller who is willing to carry back a purchase money mortgage or trust deed will set a rate lower than market interest to attract a greater number of qualified buyers without having to reduce the selling price drastically. The concept of seller financing certainly is not new, and it has been used to a considerable extent in California. The seller can finance a first or second mortgage or deed of trust, without the availability of the seller finance second. Many buyers would lack sufficient funds for the ever-increasing down payments necessitated by rising property values. Land contract. A land contract appeals to people who don't want to deal with a bank or other institutional lender, or who may have difficulty qualifying for a loan. The land contract, also referred to as a contract for deed or installment sales contract, should not be confused with what we have referred to as the contract of sale between the parties. A land contract is a form of seller financing in which the buyer takes possession of property and makes payments on its purchase, but does not receive legal title to the property for at least 1 year from the date of possession. The sales contract specifies the amount of the purchase price that must be paid before legal title is conveyed. A land contract is one alternative for a buyer who does not qualify for a regular mortgage loan. A land contract usually requires little or no down payment. The buyer takes possession of the property, but because the seller retains title, it may be less risky for the seller than other forms of financing. The seller cannot automatically eliminate the buyer's interest on default, however. Courts and legislature have rejected harsh remedies that could prevent a defaulting buyer from realizing any buildup of equity in the property. The land contract also must follow strict notice and other requirements. Any seller contemplating such a sale should not do so without first consulting an attorney to ensure that all legal requirements are met. Wraparound mortgage or trust deed. The wraparound mortgage or wraparound trust deed is also called an overriding trust deed or all-inclusive trust deed, a ITD, An AITD is a way to take advantage of a seller's existing loan with a relatively low rate of interest. The existing loan is unchanged, but the buyer receives additional funds, using the property as collateral, to make the purchase, and the lender of those new funds receives payment sufficient to cover both old and new loans. The new loan wraps around the existing loan. The advantage to the buyer is that an overall less than market rate of interest is paid on the new loan balance. The lender benefits by receiving interest based on the entire loan balance at a rate higher than the original loan rate. The lender not only earns interest on the additional loan amount, but may keep the excess earned at the new rate on the old balance as well. A buyer could give a wraparound trust deed or mortgage to a seller, who then would make payments on the first loan. It is important to note that a wraparound loan is possible only if the original band documents permit such a refinancing. An alienation clause in the original band documents would prevent a sale under such terms. An attorney should be consulted before entering into any such transaction. A wraparound mortgage makes sense only when interest rates are rising. Sale-leaseback. The sale-leaseback, or just leaseback, is a method of property transfer. It is mentioned here because it is a useful way for a financially sound but cash-poor business to gain needed capital while keeping office or other space. By selling property it owns and uses, a business gets cash. By leasing the same space back from the buyer, the business can deduct the entire lease payment from income. Not all of the property need be sold. The land alone could be sold for the same tax reasons, but buildings on the land could be kept for depreciation deductions. The buyer in a leaseback benefits by the typically higher payments of a lease over a mortgage and the property's appreciation, among other benefits. The lease term probably would be much longer, 99 years for instance, than the standard mortgage term, perhaps 25 years, assuring the buyer of a steady income stream. Exercise. Identify each of the following financing transactions. L built a small medical clinic on L's land. After 15 years, L sold the clinic. L still maintains a practice in the clinic building and plans to do so for many more years. R is making monthly payments on the house in which R lives with a child. R is buying the house but has never had legal title. D has held legal title to Blackacre for 6 months, since taking possession. D is making monthly payments of principal and interest to the former owner. J, a veteran, pays a lower than market rate of interest on a home loan, with payments paid directly to the government agency that funded the loan. The secondary mortgage market. The initial mortgage lender may be the borrower's only source of contact regarding the loan. The borrower may make all mortgage payments to the original lender and receive periodic statements of interest paid and remaining principal owed from the same source. Yet in today's mortgage marketplace, chances are that the initial lender has sold the promissory note that is the underlying obligation and is only servicing it for someone else. The sale and purchase of such obligations constitutes the secondary mortgage market. Real estate securities are a substantial source of investment opportunities for those who otherwise might seek alternate markets. This section will review the federally originated agencies that dominate the secondary mortgage market and are called Government-Sponsored Enterprises GSEs. Fannie Mae. Fannie Mae, formerly the Federal National Mortgage Association, was created in 1938 as a subsidiary of the Reconstruction Finance Corporation. Authorized by the National Housing Act of 1934, the organization was to have been privately backed, but became a government agency when no private enterprise was willing to back it, given the continuing financial challenges brought on by the Great Depression. Information about Fannie Mae can be found at fanniemae.com/singlefamily. Fannie Mae has a 15-member board of directors. 10 members are elected by shareholders, and 5 members are appointed by the President of the United States. From its original mandate to serve as a secondary market for FHA-insured and VA-guaranteed loans, Fannie Mae's authority has been expanded to take in conventional mortgage loans as well. Fannie Mae currently buys FHA and VA graduated payment mortgages, adjustable rate mortgages, and conventional fixed rate first and some qualifying second mortgages on dwellings of 1 to 4 units. A conforming loan meets Fannie Mae's underwriting criteria and dollar amount is called a Fannie Mae's conforming loan. Loans purchased by Fannie Mae cannot exceed the limits established each year using the formula prescribed in the Housing and Community Development Act of 1980. For 2022, the limit has been set at $647,200 for a loan on a single-family residence, $828,700 for a two-family loan, $1,001,650 for a three-family loan, and $1,244,850 for a loan secured by a four-family residence. Limits are 50% higher for properties in Alaska, Hawaii, the U.S. Virgin Islands, and Guam. Loan limits for other high-cost areas, including those in California, are $970,800 for a single-family home, $1,243,050 for a two-family home, $1,502,475 for a three-family home, and $1,867,275 for a loan secured by a four-family residence. The increases have enabled many more California homeowners to qualify for a loan within the conforming limit and avoid the increase in interest rates typically paid for a jumbo, non-conforming loan. Fannie Mae calls loans that are over the regular limit, but within the high-cost area limit, jumbo conforming loans. Fannie Mae will buy a block pool of mortgages from a lender in exchange for mortgage-backed securities that represent undivided interests in the group of loans. The securities may be sold or kept by the lender. Fannie Mae guarantees payment of all interest and principal to the holder of the securities. In 1968, Fannie Mae was divided into a corporation owned by private shareholders, which retained the original name, and an organization called the Government National Mortgage Association, now called Ginnie Mae, which is discussed next. Fannie Mae now issues its own common stock, and it also obtains capital from borrowing, selling notes and debentures, selling mortgage-backed securities, and money earned from its own mortgage portfolio. Ginnie Mae. Ginnie Mae, created as the Government National Mortgage Association, has brought many investors into the residential mortgage market by offering high-yield, risk-free, guaranteed securities. These securities also have none of the servicing obligations of a regular mortgage. Information about Ginnie Mae can be found at ginniemay.gov. Unlike Fannie Mae, Ginnie Mae does not buy securities. Instead, Ginnie Mae guarantees securities issued by FHA-approved home mortgage lenders. Ginnie Mae guarantees that the purchaser of privately issued securities backed by a pool of residential mortgages will receive timely payment of interest and principal, less servicing and Ginnie Mae fees. In the event of late payment by the borrower, the securities issuer advances the payment to the securities holder. Ginnie Mae securities are backed by FHA insured and VA guaranteed mortgages, as well as those guaranteed by Farmer Mac, including single-family fixed rate, graduated payment, growing equity, and manufactured home mortgage loans. Ginnie Mae. Ginnie Mae, created as the Government National Mortgage Association, has brought many investors into the residential mortgage market by offering high-yield, risk-free, guaranteed securities. These securities also have none of the servicing obligations of a regular mortgage. Information about Ginnie Mae can be found at ginniemay.gov. Freddie Mac. Freddie Mac, originally the Federal Home Loan Mortgage Corporation, was created in 1970 in direct response to the scarcity of mortgage funds. Freddie Mac provides a secondary market for residential conventional mortgage loans by buying such loans and reselling them to individual investors and financial institutions. Maximum loan amounts are the same as those set for Fannie Mae. Freddie Mac was funded initially by the sale of non-voting common stock to the Federal Home Loan Banks. Freddie Mac now issues preferred stock to the general public. You can learn more about Freddie Mac at its website, freddiemac.com. Freddie Mac. Freddie Mac, originally the Federal Home Loan Mortgage Corporation, was created in 1970 in direct response to the scarcity of mortgage funds. Freddie Mac provides a secondary market for residential conventional mortgage loans by buying such loans and reselling them to individual investors and financial institutions. Maximum loan amounts are the same as those set for Fannie Mae. Freddie Mac was funded initially by the sale of non-voting common stock to the Federal Home Loan Banks. Freddie Mac now issues preferred stock to the general public. You can learn more about Freddie Mac at its website, freddiemac.com. Congressional Oversight. The Office of Federal Housing Enterprise Oversight, OFHEO, was created by Congress in the Federal Housing Enterprises Financial Safety and Soundness Act of 1992. OFHEO was charged with making legislative recommendations that are designed to enhance the financial safety and soundness of Fannie Mae and Freddie Mac. Under the Housing and Economic Recovery Act of 2008, HERA, OFHEO was merged with the Federal Housing Finance Board, FHFB, to create the Federal Housing Finance Agency, FHFA. The website fhfa.gov has a great deal of useful information, including a house price index for all 50 states and the District of Columbia, electronic signatures, a growing number of loan originations accomplished via the Internet. This trend has undoubtedly benefited from the passage by Congress of the Electronic Signatures in Global and National Commerce Act, which took effect October 1st, 2000. Many states, including California, had already adopted the Uniform Electronic Transactions Act. The new federal law gives electronic signatures and records the same legal validity as written contracts and documents in every state. The law makes it possible for a mortgage loan to be applied for, approved, and made without a single piece of paper changing hands. Not every transaction can be carried out electronically, however. The law makes exceptions for certain documents of critical nature, such as court orders, mortgage foreclosures, termination of health insurance, utility cancellations, wills, and adoptions, which will still require written documentation on paper. Federal Housing Finance Agency, FHFA. The effort to ensure the stability of the housing market has resulted in stronger federal control over the GSEs. Fannie Mae and Freddie Mac were placed into conservatorship by the director of the Federal Housing Finance Agency, FHFA, on September 7, 2008, in accordance with the Housing and Economic Recovery Act of 2008, HERA. As the housing market has improved, so have the fortunes of Fannie Mae, which has not received funds from the Treasury since the first quarter of 2012. Nevertheless, proposed legislation may replace Fannie and Freddie with federally insured mortgage securities that would require private insurers to cover initial losses before a government guarantee would kick in. Exercise. How does a secondary market for real estate mortgage loans benefit borrowers? Summary. Non-conventional real estate loans include those insured by the Federal Housing Administration, FHA, or guaranteed by the Department of Veterans Affairs, VA. Through a variety of loan plans, these agencies use approved lenders to make lower interest, low down payment loans available for owner-occupied dwellings. Recent increases in FHA-insured loan limits should help homebuyers in high-cost areas such as California. The California Veterans Farm and Home Purchase Program, CalVet, has for many years purchased and resold residences and farms to veterans. This self-supporting program is run by the California Department of Veterans Affairs, CDVA. In a time of expensive credit, seller financing through purchase money mortgages and trust deeds can be beneficial. Sales or land contracts can be tricky, but may be useful if undertaken with the proper legal advice. The wraparound mortgage, when allowed, can benefit both buyer and seller. The sale-leaseback is a way to free up capital for a financially sound property owner. Fannie Mae has encouraged the growth of a strong secondary mortgage market by guaranteeing payment of interest and principal to holders of the mortgage-backed securities it creates by buying mortgages from lenders. Ginnie Mae guarantees securities issued by FHA-approved home mortgage lenders. Freddie Mac buys conventional residential mortgage loans for resale to investors and financial institutions. Increased limits on loans purchased by Fannie Mae and Freddie Mac should help homeowners in high-cost areas such as California, who can now qualify for conforming loan interest rates. Fannie and Freddie are now under the conservatorship of the Federal Housing Finance Agency.